Chapter 1 of the book begins with the author explaining the origins of the book, which grew out of a series of letters he wrote to his teenage daughter about money and investing. He emphasizes the importance of understanding money, as it is a powerful tool in navigating the world. However, he acknowledges that most people have better things to do with their time than think about money. The author warns against the complexity of the financial world and the charlatans who profit from it. He states that complex investments are costly and less effective, and that simple guidelines should be followed instead. These guidelines include spending less than you earn, avoiding debt, and investing the surplus. The author also advises against marrying financially irresponsible people and relying on investment advisors, as no one will care for your money better than you. The chapter continues with the author discussing the importance of financial freedom and the impact of life choices on finances. He emphasizes the simplicity of sound investing, which involves saving and investing a portion of every dollar earned. The author encourages saving and investing 50 of income, as it allows for a high savings rate and the ability to live on less. He also highlights the stock market as a powerful wealth building tool, but warns about the normality of market drops and the need to ignore panic and media hype. The chapter concludes with the author expressing his personal journey of learning these financial lessons and his hope to share them with his daughter and readers. He hopes that by following the advice in the book, readers can achieve financial freedom with fewer missteps and tears. Overall, Chapter 1 sets the stage for the book by introducing the importance of understanding money, warning against complexity and financial charlatans, and providing simple guidelines. Chapter 2 of the book presents a thought-provoking parable titled The Monk and the Minister. It tells the story of two childhood friends who take different paths in life. One becomes a humble monk, while the other becomes a wealthy minister to the king. Years later, the two friends reunite, and the minister, noticing the monk's shabby appearance, offers his help. He suggests that if the monk were to cater to the king, he wouldn't have to live a life of simplicity and subsist on rice and beans. However, the monk responds with a profound insight. He tells the minister that if he were to learn to live contentedly on rice and beans, he wouldn't have to cater to the king for his wealth and comfort. This parable serves as a reminder that most of us fall somewhere between the monk and the minister. It encourages us to reflect on our own lives and consider whether we are closer to the monk's simplicity or the minister's pursuit of material wealth. The author shares their personal perspectives, stating that they believe it is better to be closer to the monk's way of life. This chapter invites readers to contemplate their own values and priorities, urging them to find contentment in simplicity rather than constantly striving for external success and validation. Chapter 3 of the book is titled My Story. It Has Never Been About Retirement. In this chapter, the author shares their personal journey towards financial independence and how it has never been about retiring from work, but rather about having options and freedom. The author starts by explaining their natural inclination towards saving money from a young age. They recount how their savings were used to pay for college and how they learned the importance of mastering money in a fiscally insecure world. The concept of FU money is introduced, which refers to having enough money to be completely free from the demands of others and to do exactly what one wants with their life and time. The author shares that their goal was not just simple financial independence, but to have enough FU money to have the freedom to step aside from work whenever they wanted. The author recounts their first experience of having FU money at the age of 25 when they saved $5,000 and decided to take a 4-month unpaid leave to travel. Although their boss initially said no, they eventually negotiated a 6-week leave and went on a bicycle trip around Ireland and Wales. This experience taught them the power of having FU money and the ability to negotiate for what they wanted. Throughout their career, the author shares that they have quit jobs multiple times and have been laid off once. They have taken breaks ranging from 3 months to 5 years for various reasons, such as changing careers, buying a business, and traveling. They emphasize the importance of having the financial independence to make these choices and not be a slave to work. The author also shares how their wife quit her job to become a stay-at-home mom, thanks to their financial independence. They highlight the value of having time with their daughter and the joy of work when it is not a necessity. The chapter concludes with the author reflecting on their journey and the mistakes they made along the way. They emphasize the importance of a high savings rate, avoiding debt, and embracing index fund investing. They encourage readers who have made poor choices to change and find encouragement in their own journey. The author ends by expressing their happiness in retirement and the freedom it brings. They emphasize the importance of not wasting time worrying about the future and instead focusing. They encourage readers to pursue their own journey towards financial independence and to use their FU money to explore the world on their own terms. In Chapter 4 of the book, the author provides some important notes for the readers. The first note emphasizes that things change, including laws, regulations, and financial numbers. While the author has provided accurate information at the time of writing, it is important for readers to verify the current rules and numbers for their own situations. The second note discusses the projections and calculators used in the book. The author explains that these scenarios are only for the purpose of making or demonstrating a point and should not be considered as predictions of the future. The author provides the rules and settings used for the calculators and encourages readers to run their own scenarios with their own specifications. The author also mentions that most scenarios in the book are based on a 40-year period from January 1975 to January 2015, which had an average market return of 11. However, the author clarifies that this should not be considered as an expected return going forward. The author acknowledges that the market returns can vary dramatically in any given year and that it is impossible to predict the future precisely. Therefore, the author suggests using the provided scenarios as a way to explore possibilities and encourages readers to use their own reasonable percentages or time periods for analysis. In this chapter, the author discusses the dangers and consequences of debt. The chapter begins with the author's personal experience of getting his first credit card and realizing the potential harm of debt. The author emphasizes that debt is a tool used by marketers to sell products and services at higher prices. The chapter highlights the staggering amount of debt carried by Americans and the normalization of debt in society. The author argues that debt diminishes one's lifestyle, limits financial choices, increases stress levels, and creates negative emotions. The chapter provides guidance on how to pay off debt, including making a list of all debts, eliminating non-essential spending, ranking debts by interest rate, and focusing on. The author advises against paying for debt consolidation services and suggests focusing on getting rid of debt rather than seeking psychological boosts. The chapter concludes by discussing the concept of good debt and cautioning against taking on business loans, mortgage loans, and student loans without careful consideration. The author criticizes the high cost of education and the burden of student loans, which cannot be discharged through bankruptcy. The chapter emphasizes the importance of eliminating debt to achieve financial independence and build wealth. In this captivating chapter, the author shares a personal story about the importance of having what he calls FU money. It all started shortly after 9/11 when the author's company unexpectedly let him go, despite previously celebrating his success. Suddenly, he found himself unemployed and unsure of what the future held. One day, while watching a news broadcast with his young daughter, they saw people standing in a bread line, suffering from job loss in the struggling economy. Concerned, his daughter asked if they were poor. The author reassured her that they were not, explaining that they had money working for them instead. But deep down, the author knew that having FU money was the reason they were not in the same dire situation as those on the news. He had been working towards financial independence long before he even knew the term. He understood that money could buy many things, but the most valuable was freedom, the freedom to do what you want and work for those you respect. The author emphasizes that those who live paycheck to paycheck are essentially slaves, and those burdened with debt have even stronger shackles. He warns that their masters, whether they be employers or creditors, are well aware of this power dynamic. The author recounts how he first accumulated enough FU money to negotiate extra vacation time early in his career. Over time, The amount grew, providing him with the freedom to say "fu" if necessary. This freedom became even more crucial when he found himself in a heated argument with his boss and realized it was time to live. Little did he know that his decision to prioritize financial independence would prove to be a lifesaver. After 9/11, he remained unemployed for 3 long years. Despite the challenges of job hunting, he was grateful for the peace of mind that came with owning his freedom. This chapter serves as a powerful reminder of the importance of having FU money. It's not about being wealthy or owning luxury items. It's about having the financial security to make choices and live life on your own terms. The author's personal experiences highlight the value of this freedom and the potential consequences of not having it. In this chapter, the author explores the possibility of every middle-class wage earner retiring as a millionaire. The numbers show that it is indeed possible, with just a small amount of money invested over time. For example, $12,000 invested in the stock market in 1975 would be worth over $1 million today. Even if you don't have that much money to invest, starting with just $130 per month could still lead to a substantial amount by retirement. The author also discusses the concept of financial independence and how it can be achieved by living frugally and saving diligently. They provide examples of people who have achieved financial independence on modest incomes through careful budgeting and investing. On the other hand, the author also highlights the importance of limiting needs and avoiding excessive spending. They emphasize that being independently wealthy is not just about how much money you have, but also about how you manage it. The chapter concludes by urging readers to question their beliefs about what they truly need in order to achieve financial independence and build wealth. In this chapter, the author discusses how to think about money and the different perspectives that can lead to financial success or failure. The chapter begins by asking readers to consider what money means to them and the various ways it can be used. The author presents for different views on money, spending it, investing and reinvesting it, and thinking about the long-term growth and compounding effects of money. To illustrate the importance of thinking about money, the author uses the example of Mike Tyson, a former boxer who earned millions of dollars but ended up bankrupt due to his focus on spending. The author emphasizes that many people, not just athletes like Tyson, struggle with understanding money and its potential for growth. The chapter then introduces the concept of opportunity cost, which is the cost of choosing one thing over another. The author explains that even if you pay for something in cash, there is still an opportunity cost because that money could have been invested and earned a return. Using the example of buying a car, the author shows how the opportunity cost of not investing the money can add up over time. Next, the author discusses how to think about investments using Warren Buffett as an example. Buffett is known for his long-term investment strategy and his focus on owning businesses rather than just buying and selling stocks. The author encourages readers to think of their investments in the same way as owning a piece of companies that have the potential to grow and generate income over time. The chapter concludes by emphasizing the importance of learning how to think about money and the power it has to shape our financial future. The author suggests that it is never too late to change our perspective and start making better financial decisions. In this chapter, the author discusses the challenges and fears that come with investing in a raging bull or bear market. They emphasize that it is impossible to time the market and that the market is a powerful wealth-building tool. The author addresses common concerns and questions from novice investors, such as whether it is a good time to invest or if they should wait for a market crash. They explain that fear and greed are the two major emotions that drive investors, but fear can be deadly to wealth if not mastered. The author also highlights the volatility of the market and the inevitability of market crashes and corrections. They argue that successful investing is long-term and that trying to time the market is speculation. The author uses historical data to show that while the market always goes up over time, it is impossible to predict short-term market movements. They caution against trying to time the market and emphasize the importance of staying invested and riding out market fluctuations. The chapter concludes by stating that investing in stocks is a personal decision and that asset allocation can help smooth out the ride. Chapter 6 of the book starts off with the author feeling testy after reading an article featuring an interview with a famous economist. The economist argues that the theory of efficient markets is changing due to new trading technologies, making the market more volatile and rendering the buy and hold strategy ineffective. However, the author disagrees with this conclusion and believes that investors should toughen up and cure their bad behavior instead. The author criticizes the economist's recommendation of holding a variety of mutual funds and suggests that investors should recognize and correct their counterproductive psychology that leads to bad investing. The author then goes on to discuss the inevitability of market crashes and the importance of staying the course during these times. They emphasize that the market always recovers and that it is the best performing investment class over time. The author also highlights the fact that the market always goes up, although not in a smooth manner, and that there will always be collapses, recessions, and disasters in the future. They stress the need for investors to toughen up, ignore the noise, and ride out the storm. The author concludes the chapter by stating that there will be more market crashes in the future, but they should be seen as buying opportunities rather than the end of the world. In the upcoming chapters, the author promises to discuss why the market always goes up and provide guidance on how to invest at each stage of life to become rich and stay that way. They emphasize that the process is simple but requires investors to be tough. In this chapter, the author shares a personal story about the stock market crash of 1987, also known as Black Monday. He recounts how he initially held firm and didn't panic, but eventually lost his nerve and sold his stocks. However, he learned from this experience and became tougher and more resilient in the face of future market storms. The author emphasizes that despite the volatility and occasional crashes, the market always goes up in the long run. He presents a chart of the Dow Jones Industrial Average from 1900 to 2012, highlighting the market's upward trajectory over time. The author explains that the market always goes up because it is self-cleansing, with companies fading away and being replaced by new ones. Additionally, owning stock means owning a part of dynamic companies that are constantly striving to succeed. The author concludes by acknowledging that while the market's upward climb is a great wealth-building tool, it can also be a wild and unsettling ride with occasional big, ugly events. In this chapter, the author discusses why most people lose money in the stock market. He explains that one of the main reasons is because people believe they can time the market, buying high and selling low. This behavior is a result of our psychological makeup and is difficult to change. The author also explains that picking individual stocks is another common mistake, as even professionals struggle to consistently pick winners. Additionally, many people believe they can pick winning mutual fund managers, but the reality is that most funds fail to outperform the index. Lastly, the author emphasizes the importance of focusing on the actual businesses in the stock market, rather than getting caught up in the daily fluctuations and noise of the market. Overall, the chapter highlights the common pitfalls that led to financial losses in the stock market and encourages readers to adopt a long-term, diversified investment strategy. In this chapter, the author introduces the concept of the big ugly event, the stock market crash of 1929 and the beginning of the Great Depression. The author emphasizes that while the stock market is a powerful wealth-building tool, it is also extremely volatile and crashes can cause significant losses. However, the author argues that if investors can toughen up, ride out the turbulence, and remain humble about their investing abilities, they can still achieve wealth through the stock market. The author presents several key points about the big ugly event. Firstly, they highlight that it would have taken exceptionally bad luck to have experienced the full weight of the crash, as the outcome would have varied depending. Secondly, the author suggests that a crash at the beginning of an investor's career can actually be a gift, as it provides opportunities to buy stocks at bargain prices. Thirdly, the author explains that while the crash may have caused a significant hit to a retiree's portfolio, The deflationary nature of the Depression meant that the remaining funds had more buying power. The author also notes that the big ugly event has only occurred once in the last 115 years and argues that with the controls put in place since 1929, it is unlikely. They draw encouragement from the fact that in 2008, the economy came close to another major crash but managed to avoid it. However, the author warns that hyperinflation is another economic disaster that can destroy wealth on a major scale, and it is just as destructive as deflation. They explain that a little inflation is healthy for the economy, but when it spirals out of control, it can lead to a deadly cycle of increasingly worthless currency. The author concludes the chapter by highlighting that stocks are a good inflation hedge and that the decision every investor must make is how much risk they are willing to accept in the wealth building process. They acknowledge that big ugly events are scary and destructive, but they are also rare and survivable. In the next few chapters, the author promises to discuss specific investments to build and protect wealth, emphasizing that the process is simpler than most people believe. Chapter 10 of the book emphasizes the importance of simplicity in investing. The author argues that complex investments are less likely to be profitable and can be costly. They also highlight the financial incentives for companies to promote complex investments. The chapter introduces three considerations for investors: their stage of investing life, their level of risk tolerance, and their investment horizon. The author advises readers to build their FU money, which is the financial freedom to withstand unexpected changes in employment. The chapter also challenges the idea of short-term investing and encourages a long-term perspective. The author then introduces three tools for building a portfolio: stocks VTSAX, bonds VBTLX, and cash. These tools serve as a wealth builder, inflation hedge, deflation hedge, and cover for daily expenses and emergencies. The chapter concludes by mentioning that readers can fine-tune their allocation in each investment based on their personal considerations. The upcoming chapters will delve into index funds, bonds, specific strategies, and selecting the best asset allocation. Overall, the chapter emphasizes the simplicity and effectiveness of the recommended investment approach. In this chapter, the author challenges the misconception that index funds are only for lazy investors. He introduces Jack Bogle, the founder of Fivingward and the creator of index funds, as a financial industry titan and investing saint. Bogle himself admits that he has never met anyone who can consistently beat the market, and the author agrees with this sentiment. The concept of indexing is based on the idea that buying all the stocks in a market index will outperform professional management, especially when considering costs. The author argues that trying to pick winning individual stocks is a fool's errand and that even the top-tier money managers often rely on luck rather than skill. Despite the evidence supporting indexing, many people resist the idea. The author suggests that this resistance may stem from the challenge of accepting that they can't outperform an index, the desire to be above average, the influence of financial media stories. The author personally chooses indexing because it is more effective and powerful in building wealth than other alternatives. They emphasize that indexing is not just easier or simpler, but it provides better returns. The chapter concludes with the advice to keep your feet firmly on the ground with indexing unless you are Warren Buffett. In this chapter, the author introduces the concept of bonds and explains why they are an important part of a diversified investment portfolio. Bonds are seen as the more steady and reliable cousins to stocks, providing stability and income flow. The author breaks down the topic of bonds into stages, allowing readers to stop reading once they feel comfortable with the information provided. The first stage discusses how bonds serve as a hedge against deflation and provide a smoother investment road. Bonds also pay interest, with some types of bonds offering tax-free interest. The second stage explains the difference between stocks and bonds. Stocks represent ownership in a company, while bonds involve loaning money to a company or government agency. Bonds are beneficial during deflation as the money lent has more purchasing power when paid back. On the other hand, stocks are better during inflation as they rise in value. The third stage emphasizes the importance of holding bonds in an index fund as it reduces risks associated with individual bonds. The author recommends 5 Total Bond Index Fund, which holds a diverse range of investment-grade bonds. The fourth stage delves into the risks associated with bonds. Default risk is the risk of the bond issuer not paying back the loan. Various rating agencies evaluate the creditworthiness of bond issuers, with lower ratings indicating higher risk. Interest rate risk is the risk associated with selling a bond before its maturity date, as the value of the bond fluctuates with changes in interest rates. The longer the term of a bond, the greater the risk. Inflation risk is the risk that inflation will decrease the value of the money lent. The fifth stage discusses additional risks such as credit downgrades, callable bonds, and liquidity risk. These risks can be mitigated by owning a broad-based bond index fund. The sixth stage introduces municipal bonds, which are issued by governments and government agencies at the state and local levels. Municipal bonds offer lower interest rates but are exempt from federal income taxes and often state income taxes. The seventh stage acknowledges the vast variety of bonds available, including those issued by national governments, state and local governments, government agencies, and companies. However, the author concludes the discussion here, as the goal of the book is to provide a simple path to wealth. In this chapter, the author presents 2 portfolio ideas to build and keep wealth. The first portfolio, called the Wealth Accumulation Portfolio, is designed for young and aggressive investors who want to build their wealth quickly. The author advises putting all your eggs in one basket, specifically the 5 Total Stock Market Index Fund, which holds virtually every publicly traded company in the U.S. The author emphasizes the importance of staying the course and not panicking during market ups and downs. The second portfolio, called the Wealth Preservation Portfolio, is designed for those who are nearing retirement or prefer a smoother ride with lower volatility. In addition to the 5 Fund, this portfolio includes the 5 Total Bond Market Index Fund and a cash allocation. The bonds provide income and help smooth out the volatility of stocks, while cash provides liquidity. The author encourages readers to fine-tune these allocations based on their personal considerations and risk tolerance. Overall, the chapter provides practical portfolio ideas for different stages of life and investment goals. It emphasizes the importance of long-term investing, staying the course, and choosing the best performing asset class for wealth accumulation. In this chapter, the author discusses the importance of selecting the right asset allocation for your investment portfolio. They emphasize the simplicity and effectiveness of a balanced approach using just 2 funds, 5 Vanguard Total Stock Market Index Fund for the wealth accumulation stage, and the author acknowledges that everyone's situation is unique and that the divisions between stages may not always be clear-cut. They also consider factors such as effort and risk tolerance when determining the appropriate asset allocation. For those willing to put in more effort, adding a small percentage of bonds to the portfolio can help smooth out market volatility. Rebalancing the portfolio periodically is also recommended to maintain the desired allocation. However, for those who prefer a hands-off approach, target retirement funds TRIFs are a viable option as they automatically rebalance for you. The author also discusses the importance of considering age and flexibility when determining asset allocation. As age advances, options may become more limited, and the time for investments to recover from market downturns decreases. The chapter concludes by addressing common questions about rebalancing, such as the optimal time of year to do it and how to rebalance across different types of investment accounts. The author also presents different perspectives on the frequency of reallocation and emphasizes that rebalancing is a personal choice. Overall, this chapter provides readers with the tools and considerations necessary to create an asset allocation that aligns with their goals and circumstances. In this chapter, The author discusses the topic of international funds and why they are not included in his recommended to fund portfolio. He starts by acknowledging that many advisors recommend investing in a wide range of funds and asset classes, but he believes that this approach requires a lot of work and may not lead. The author then addresses the question of why international stocks are not included in his portfolio. He lists three reasons: added risk, added expense, and the fact that the portfolio already covers the benefits of international exposure. The first reason is currency risk. When investing in international companies, their performance is influenced by the fluctuation of their home country's currency against the US dollar. This adds an additional dimension of risk to international funds. The second reason is added expense. The author explains that even low-cost five-inward international funds have expense ratios that are at least twice as high as the expense ratio of the recommended fund in his portfolio. The third reason is that the author believes the benefits of international exposure are already covered in the portfolio. He points out that many of the largest US companies generate a significant portion of their sales and profits overseas. Therefore, investing in these companies provides access to the growth of world markets while filtering out most of the additional risk associated with international funds. The author also addresses the argument that international markets offer diversification and the potential for enhanced returns. He argues that as world economies become more interconnected, the correlation between international and US markets is increasing. Therefore, the diversification benefits may not be as significant as they once were. However, the author acknowledges that some readers may still want to include international funds in their portfolio. He suggests three five-inward options for those who want more international exposure: 5WAX, 5TX, and 5. These funds invest in international markets, excluding the US, and can be used to complement the recommended US-focused fund. In conclusion, the author presents his perspective on international funds and explains why they are not included in his recommended portfolio. He emphasizes the importance of understanding the risks and costs associated with these funds before making a decision. In this chapter, the author presents an alternative option for building wealth with minimal effort and simplicity. He acknowledges that some readers may be hesitant about managing multiple funds and the need for rebalancing. For those seeking a straightforward approach, the author introduces target retirement funds, TRIFs, offered by Five-Inward. TRIFs are a series of 12 funds that cater to different retirement years, ranging from 2010 to 2060. The concept is simple. You choose the fund that aligns with your planned retirement year, and the fund takes care of asset allocation and adjustments over time. Five-Inward's TRIFs are funds of funds, meaning they hold several low-cost index funds, including the Total Stock Market Index Fund, Total Bond Market Index Fund, Total. As retirement approaches, the TRIFs automatically become more conservative and less volatile. The expense ratios for these funds range from 0.14 to 0.16, making them a cost-effective option. While some critics argue that the funds may become too conservative too soon or too aggressive for too long, the author believes Five-Inward strikes a good balance. However, the author does express a slight preference for the approaches described in earlier chapters. He highlights that the expense ratios are even lower in those strategies, and he personally doesn't see the need for additional international coverage beyond what the Total Stock Market Index Fund. Additionally, managing separate funds allows for tax advantages, as bonds can be held in tax-advantaged accounts. Target retirement funds are commonly found in employer-sponsored retirement plans like 400 Onex and 400. These plans offer tax advantages, making TRIFs an attractive option. The author recommends considering TRIFs if they are available in your company's retirement plan or if you prefer a simple yet effective portfolio. Overall, TRIFs provide a simple path to wealth accumulation, making them a viable option for many individuals seeking a hassle-free investment strategy. In this chapter, the author addresses the issue of not being able to buy 5 SACs or Five-Inward mutual funds. While the author recommends these funds, They may not be accessible to everyone due to high minimum investments or lack of availability in certain countries or retirement plans. However, the author provides alternatives to consider. The first thing to understand is that 5 SACs and 5 bulks are just specific funds that hold the total stock market index and total bond market index portfolios, respectively. 5ing Ward offers variations of these portfolios in other funds or classes. For individual investors, there are Admiral shares, investor shares, and ETF versions. The ETF version may be preferable due to its low expense ratio, but be cautious of additional costs associated with buying or selling it. For those with employer-sponsored retirement plans, there are institutional shares options. These variations may have different expense ratios and minimum investments. The key is to ensure that you are buying the 5ing Ward Total Stock Market Index or Total Bond Market Index portfolio. If 5ing Ward is not available in your employer's plan, the author suggests looking for low-cost index funds offered by other major mutual fund companies. These funds should ideally be total stock market index funds or S&P 500 index funds. Total bond market index funds may also be available. However, be wary of target retirement funds trusts as they often have higher fees compared to index funds. For international readers, 5ing Ward may or may not be available outside the U.S. If not, the same guidelines for tax-advantaged plans apply. Consider global funds like 5 SCs or 5t, but be mindful of expense ratios and trading costs. In conclusion, if 5 SACs or 5 bulks are not accessible, look for 5ing Ward variations that offer the same index portfolios. If 5ing Ward is not an option, seek similar low-cost funds from other reputable investment companies. And, if possible, consider rolling your investments into 5ing Ward in the future. In this chapter, the author discusses why 5ing Ward is a special and unique investment company. Unlike other investment companies, 5ing Ward is client-owned and operated at cost. This means that as an investor in 5ing Ward funds, your interests align with 5ing Ward's because the funds and investors are the owners of 5ing Ward. Other investment companies have 2 masters to serve the company owners and the investors in their funds. This often leads to higher fees and profits for the owners. However, with 5ing Ward, any profits generated by the fees go back to the investors. This structure allows 5ing Ward to charge lower fees compared to other investment companies, resulting in a cost advantage for investors. The author also addresses common concerns about holding all assets with one company, assuring readers that their investments are not directly tied to 5ing Ward and are held separately as individuals. 5ing Ward is regulated by the Securities and Exchange Commission and has a comprehensive disaster recovery plan in place. The author emphasizes that they are not affiliated with 5ing Ward and are not being paid to promote the company. Overall, 5ing Ward's unique structure and low fees make it a recommended choice for investors. In this chapter, the author discusses the different types of buckets in which investments can be held. The author explains that these buckets are not investments themselves, but rather the containers that hold the investments. The chapter provides a simple explanation of each type of bucket and offers considerations for where to hold different types of investments. The author also discusses withdrawal strategies to minimize taxes and provides resources for further reading on the topic. The chapter concludes with a hierarchy for deploying investment money and a recommendation to roll 400 ONEC 400 thrift accounts into personal IRAs whenever possible. Overall, the chapter provides a comprehensive overview of the different types of buckets and their implications for retirement savings. Imagine waking up on your 70th ONETWO birthday, feeling content and secure in your wealth. You've diligently saved and invested over the years, and now you have a significant amount of money in your tax-deferred accounts. But little do you know, Uncle Sam is waiting to collect his share. This is the ugly surprise at the end of the tax-deferred rainbow. In this chapter, the author discusses required minimum distributions rules and how they can catch you off guard. Once you reach 70 ONETWO, withdrawals from your tax-advantaged accounts become mandatory. Failure to take these distributions can result in a 50 penalty, and the government will even take 50 of any shortfall. It's a situation you definitely don't want to overlook. The good news is that companies like Fivingword make setting up and taking these distributions easy and automatic. They will calculate the correct amount and transfer it to your chosen account on schedule. However, the bad news is that these withdrawals can push you into higher tax brackets. Depending on your other sources of income, you could find yourself paying a significant amount in taxes. To give you an idea of the potential impact, the author provides an example using Fidelity's calculator. Even with substantial withdrawals, the total value of your account will continue to grow. However, the market's performance can vary, and it's important to consider that these are estimated projections. The author also explains how the tax brackets work and how rooms can push you into higher tax rates. However, it's important to note that you only pay the higher rate on the amount over the threshold, not the full RMD. Deductions and exemptions can also reduce your taxable income. Is there anything you can do to mitigate the impact of rooms? The author suggests that if your tax bracket drops when you retire, you have a window of opportunity to reduce your tax-advantaged account holdings before reaching 70 net worth. By withdrawing the difference and taking the 15 tax hit, you can potentially lock in a lower rate. This strategy is especially beneficial if your tax bracket is expected to increase in the future. Ultimately, there is no one-size-fits-all solution. If your tax-advantaged account amounts are low, you can leave them alone. But if they are high, it might make sense to start withdrawing them even at a higher tax rate. The key is to be aware of the looming rooms and plan accordingly. As always, it's important to stay updated on current tax laws as they may change over time. Be sure to look up the specific numbers applicable to the year you are reading this book. In Chapter 21 of the book, the author discusses the increasing popularity of high-deductible health insurance plans and the creation of health savings accounts so as to help individuals. The author explains that these are like an IRA for medical bills, allowing individuals to set aside pre-tax money to pay for qualified medical expenses. The chapter highlights key points about CIS, such as the tax-deductible contributions, the ability to withdraw money tax and penalty-free for medical expenses, and the option to invest. The author suggests that fully funding an HSA and investing the money can provide a tax-free growth opportunity, similar to a Roth IRA, while still having the funds available for medical. The chapter concludes by emphasizing the importance of funding an HSA for those with high-deductible insurance plans and the potential benefits it can offer as an investment tool. In this chapter, the author presents a real-life case study of a Ritter who is looking to implement the strategies discussed in the book. The Ritter is a 26-year-old who has recently graduated from college and has a good job with no debt. He has an investment fund that was set up by his grandparents, but he wants to take control of his own investments. The Ritter is considering investing in Fivingword's total stock market index fund VTSAX and wants to know the best way to contribute to his funds. The author provides guidance on how to allocate his investments among different accounts, such as his employer's 403 plan, a deductible IRA, and an ordinary investment account. The author also suggests increasing the Ritter's savings rate to 50 and explains the power of compounding over time. Overall, this chapter provides a practical example of how to implement the strategies discussed in the book and achieve financial independence. In this chapter, the author discusses why they don't like investment advisors and why individuals should be cautious when seeking financial advice. The author argues that most advisors don't get better results than individuals can achieve on their own. They explain that the financial industry makes investing seem complex to justify the high fees charged by advisors. The author also highlights the conflict of interest between advisors and their clients, as advisors are often drawn to investments that pay high commissions and management fees rather than the best. The chapter explores different ways in which advisors earn money, such as through commissions, the AUM assets under management model, and hourly fees. The author emphasizes that these methods often work against the client's best interests and can result in significant costs over time. The chapter concludes by suggesting that individuals can learn to manage their money themselves with better results and lower costs than relying on an advisor. In this chapter, the author shares their personal experience of resisting the concept of indexing for a long time and how it hindered their wealth growth. They introduce Jack Bogle, the founder of Fivingward Group and the creator of the modern low-cost index fund, as their personal hero. Bogle's revolutionary idea challenged the financial industry's practice of enriching themselves at the expense of customers. Despite facing criticism and backlash from Wall Street, Bogle's S&P 500 index fund proved his theories in the real world. Over the years, as evidence supporting indexing piled up, Bogle's critics began to soften their voices. Other fund companies also started offering low-cost index funds to retain customers. However, the author remains loyal to Fivingward, believing that their interests align with those of their shareholders. The concept behind indexing is to buy every stock in a given index, as the odds of selecting outperforming stocks are very small. While this idea was initially ridiculed, it has been repeatedly confirmed over the past 4 decades. Even Warren Buffett, a successful stock picker, recommends indexing for his wife's trust. Despite the growing acceptance of indexing, some still bash the concept due to human greed, psychology, and money. Actively managed funds and managers continue to exist because there is too much money to be made, and human psychology is susceptible to their tactics. Currently, there are more stock mutual funds available than there are publicly traded U.S. companies, highlighting the industry's relentless creation of new products and schemes to line their own pockets. The author's advice is to use index funds and stick with the company Jack Bogle created, Fivingward, in order to keep what is rightfully yours. In this chapter, the author shares a personal story about his experience with stock picking and why it's nearly impossible to consistently beat the market. He starts by admitting that even professionals struggle to pick winning stocks. He then recounts a time when he met someone from an investment research firm who gave him 3 stock tips. He randomly picked one and watched it triple in value, which led him to join the firm. However, despite being surrounded by highly knowledgeable analysts, accurately predicting stock performance remained elusive. The author explains that predicting stock performance is challenging because it relies on forecasting the future, which is inherently uncertain. Sales forecasts from field salespeople are passed up the chain, with each level of management making their own guesses and adjustments. This process results in numbers that are often far from reality. The author realizes that his belief that reading a few books and annual reports would give him an edge over professionals and executives was misguided. He emphasizes that even rockstar fund managers struggle to consistently beat the market, and more fortunes have been made by brokering trades than by making them. The author dismisses the idea that individuals can easily outperform the market and warns against dangerous overconfidence. He likens it to thinking that one could step into the boxing ring with heavyweight champions like Muhammad Ali without proper training and experience. The chapter concludes with the author reiterating Warren Buffett's recommendation for individual investors: low-cost, broad-based index funds. He acknowledges that some may still choose to try and beat the market, but emphasizes the importance of humility in protecting one's assets. In this chapter, the author discusses why they are not a fan of dollar-cost averaging DCA when it comes to investing a large sum of money. They explain that DCA involves dividing the money into equal parts and investing those parts at specific times over an extended period. The idea behind DCA is to eliminate the risk of investing all at once, especially if the market is volatile. However, the author argues that DCA only works if the market drops and the average cost of shares remains below the initial cost. They point out that the market tends to rise more often than it falls, making it more likely that investors will miss out on potential gains by using DCA. Additionally, DCA can disrupt asset allocation and requires choosing a time horizon, which can increase the risk of paying more for shares. The author suggests that instead of DCA, investors should consider their wealth accumulation or preservation phase and invest accordingly. They recommend putting lump sums to work as soon as possible and letting asset allocation mitigate risk. However, if investors are too nervous, they can still choose to DCA, but it means adjusting investing to psychology rather than the other way around. In this chapter, the author takes us back to the days of Lise Rukeyser's Wall Street Week, a popular PBS program that discussed the stock market. The author reminisces about watching the show and being fascinated by the rotating panel of Wall Street gurus who would offer their insights and predictions. The author highlights the importance of opposing views and how Rukeyser would schedule guests with different perspectives to provide a balanced discussion. The author mentions two favorite gurus, Abby Joseph Cohen and Marty Zweig, who always had contrasting opinions on the market. One key lesson the author learned from the show is that there will always be experts predicting various outcomes for the market. With so many possibilities, someone is bound to be right, and their success will be seen as wisdom and insight. The author also mentions Rukeyser's annual tradition of having guests predict the market's high, low, and ending point for the year. The author then humorously outlines a step-by-step guide on how to become a stock market guru and get on CNBC. The steps include making a dramatic prediction, documenting it, waiting for it to come true, and then issuing a press release to claim credit. The author adds a playful note, suggesting that they should receive a 15 agents fee for their guidance. However, the author warns that once you establish yourself as a guru, you will be under scrutiny, and any missteps will be documented and used against you. Despite the potential fame and fortune, the author concludes that being a stock market guru is not their ambition. Overall, this chapter provides an entertaining look at the world of stock market gurus and the allure of making predictions in the financial industry. It serves as a reminder to approach these predictions with caution and not to take them too seriously. In this chapter, the author shares a personal story about trying to protect a widow from financial predators. The widow's late husband had left her a substantial amount of money, but he was concerned about her susceptibility to scams. The widow believed in the concept of a free lunch and was always open to come-ons, such as getting free cell phones without realizing the hidden contracts. The author tried to explain the risks of financial predators to her, but she confidently declared that she couldn't be conned. This statement, however, violated the first rule of not being conned. The author then proceeds to share a scam he came across many years ago. It involved receiving a letter or a mail from an investment advisor who offered a stock tip. The advisor claimed to have proprietary metrics that indicated a strong buy for a particular stock. The recipient of the letter decides to keep an eye on it and sees the stock sharply rise, confirming the advisor's prediction. This pattern continues with subsequent letters predicting the fall of other stocks. Eventually, the recipient receives an invitation to a dinner where the advisor will discuss his investment metrics and offer spots in his latest investment pool. The trick is that the advisor is using an inverted pyramid scheme, targeting individuals who have received multiple correct predictions in a row. The author then presents 5 rules to remember when it comes to being conned. The first rule is that everyone can be conned, regardless of intelligence or knowledge. The second rule is that people are more likely to be conned in areas of their expertise because they feel secure and safe in those areas. The third rule is that con men don't look like con men, they appear trustworthy and honest. The fourth rule is that most of what con men say will be true, with the con carefully hidden in the fine print. The fifth rule is that if something looks too good to be true, it probably is. The author emphasizes the importance of having conversations about scams and financial protection with spouses or partners. They share that they regularly have these discussions with their own spouse and review their investments. The author also mentions their preference for index funds, as they want to live their spouse with a simple portfolio that can be left on autopilot. Overall, this chapter serves as a cautionary tale about the dangers of financial predators and the importance of being aware and vigilant. It highlights the fact that anyone can be conned and provides valuable rules to remember in order to protect oneself from scams. In this chapter, the author discusses withdrawal rates and how much one can spend in retirement without running out of money. The chapter begins by mentioning the 4 rule, which states that one can withdraw 4 of their assets each year and still have enough to last for 30 years. This rule was derived from a study conducted by 3 professors from Trinity University in 1998. The study looked at various withdrawal rates and portfolio compositions over 30-year periods and found that a 4 withdrawal rate with a 50-50 stock-bond portfolio adjusted for inflation had an. In other words, there was only a 4 chance of this strategy failing and leaving one destitute in old age. The author emphasizes that in most cases, people could have taken out higher percentages, such as 5, 6, or even 7, and still been fine. However, the financial media focused on the 4 rule because it was seen as a safe bet. The chapter also mentions that more recent start years have not yet had their own 30-year runs, so it's important to be cautious. The author provides a link to the Trinity study for those who want to learn more. In summary, withdrawing 3 or less annually is a safe bet, while straying much further out than 7 can lead to financial difficulties. Stocks are crucial for a portfolio's survival, and a 4 withdrawal rate with a 75 stocks 25 bonds mix is a sure thing. Giving up yearly inflation raises allows for a higher withdrawal rate, and the authors of the study suggest that up to 7 is possible as long as one remains alert and flexible. The chapter concludes by mentioning the 4 tables in the study, which show how portfolios performed over time and how much money remains after 30 years. In this chapter, the author presents tables that demonstrate the impact of different withdrawal rates and inflation adjustments on the survival and remaining value of a portfolio over 30 years. The tables show that a 4 withdrawal rate without inflation adjustments has a 100 chance of the portfolio surviving, while with inflation adjustments, the chance drops to 96. The author then provides examples of the remaining value of portfolios with different asset allocations after 30 years, highlighting the importance of stocks in building and preserving wealth. The author also emphasizes the critical importance of using low-cost index funds to build a portfolio, as high fees can significantly impact the success rate. The chapter concludes with the author sharing their personal withdrawal rate and explaining the factors that influence it, such as expenses, travel, and future income streams. The author emphasizes the importance of personal flexibility in choosing a withdrawal rate and provides guidance for a secure retirement. Overall, this chapter highlights the power of stocks and low-cost index funds in building and preserving wealth, and encourages readers to consider their individual circumstances when choosing a will. In this chapter, the author discusses how to reach a point where your assets can cover all your financial needs, allowing you to choose to have your assets pay the bills rather than relying on labor. The author emphasizes the importance of savings rate and cash flow requirements in determining how quickly you can reach this point. The author also provides guidance on how to allocate your investments, suggesting 5 Vanguard's low-cost index funds for stocks and bonds. The chapter goes on to explain the mechanics of withdrawing money from your investments, highlighting the ease of doing so with firms like 5 Vanguard. The author also shares guiding principles for their approach, such as looking at all funds combined regardless of where they are held and letting tax-advantaged investments grow tax-deferred as long as. The chapter then delves into the author's personal strategy for withdrawing the 4 needed for expenses, including considerations for non-investment income, offloading certain assets, and shifting. The author emphasizes the importance of flexibility in adjusting withdrawals based on market conditions and recessing annually. Overall, the chapter provides practical advice and strategies for withdrawing funds from your investments to cover expenses in retirement. In this chapter, the author discusses the topic of Social Security and its security for future generations. The chapter begins with the author reminiscing about a conversation with their mother in the 1980s, where they expressed doubts about the future of Social Security. However, As they approach the age of collecting Social Security themselves, they realize that it may be a more beneficial program than they initially thought. The chapter provides a historical background on Social Security, explaining that it was created in 1935 during the Great Depression to provide financial support for the elderly. At that time, life expectancies were much lower, and the age of 65 was set as the age to collect Social Security, assuming that few people would live long enough to collect from. However, as life expectancies have increased and the baby boomer generation begins to retire, the system is facing challenges. The chapter outlines a timeline of how the system will change in the coming years, with the surplus funds eventually running out and payroll taxes only covering 75 of scheduled benefits. The author also addresses concerns about the existence of the trust fund, which holds the surplus funds. They explain that the trust fund is held in U.S. Treasury bonds and is considered a safe investment. While there is no physical lockbox of cash, the bonds have real value and are backed by the U.S. government. The chapter then delves into the question of when to start taking Social Security benefits. The author suggests considering factors such as financial need, belief in the feature of Social Security, life expectancy, and spousal benefits. They argue that the government actuarial tables are accurate, and the decision should be based on individual circumstances. Addressing concerns about the feature of Social Security, the author points out that the program is backed by the powerful AARP lobby and that politicians are unlikely to take away benefits. However, they acknowledge that changes will need to be made for future generations, such as smaller promised benefits, higher income caps, and a higher retirement age. In conclusion, the author recommends planning for the future without relying on Social Security and emphasizes the importance of financial independence. They suggest living below one's means, investing wisely, and accumulating savings. While Social Security may still be there, it is better to be prepared and enjoy any benefits that come later. The chapter ends with a recommendation to check one's Social Security account online to track earnings and ensure accuracy. In this chapter, the author shares his personal experience with charitable giving and how it has brought him and his wife immense joy. He recounts a story of attending a charitable auction and winning a gourmet dinner for 10 at a local restaurant. Instead of keeping it for themselves, they decided to gift it to their daughter's Catholic grammar school and asked the mother superior to choose which teachers would attend. The act of generosity sparked a chain reaction, with the restaurant owner expanding the donation to dinner for 15 and another bidder offering to pay for the wine. The event turned out to be a memorable and enjoyable experience for everyone involved. The author also discusses the tax benefits of charitable giving and how it can be advantageous to set up a charitable foundation. He recommends using the Fiving-Word Charitable Endowment Program, which allows individuals to open their own foundation with as little as $25,000. By donating appreciated assets, such as stocks or mutual funds, directly to the foundation, individuals can receive a tax deduction for the full market value and avoid paying capital gains. The author emphasizes the importance of doing research and selecting charities wisely, as not all organizations are efficient in delivering funds to those in need. Additionally, the author encourages giving outside of traditional tax-deductible avenues, such as helping friends and neighbors directly. While these acts may not provide a tax benefit, they have immediate positive impacts on the community. The author concludes by stating that giving is a personal choice and that individuals should make their own decisions about charitable giving without feeling obligated to do so. In this chapter, the author shares their advice for financial success in the first 10 years of adulthood. They emphasize the importance of avoiding debt and surrounding yourself with financially responsible people. The author encourages readers to work hard and build their careers while also being open to new adventures. Saving and investing at least 50% of your income is recommended, along with taking advantage of employer tax-advantaged plans and individual retirement accounts. The author explains that by following this plan for about a decade, individuals can achieve financial independence. They also discuss the concept of living on investments once financially independent and the potential for continued growth. The chapter concludes with suggestions for expanding one's lifestyle, giving back, and making important life decisions such as having children or buying a house. The author's overall message is that it's never too late to start on the path to financial success and that the future holds endless possibilities. In this chapter, the author shares two inspiring stories of individuals who have chosen to live life on their own terms. The first story is about a man named Muck, an American who ended up owning a hotel in Tahiti. Muck and his friends, with no experience in pineapple growing or hotel management, took a leap of faith and bought a pineapple plantation in Tahiti. When they realized they couldn't make a living from it, they were offered the opportunity to finish a half-built hotel by the local bank. Despite their lack of experience, they successfully completed the hotel and went on to build and operate others. Muck's story is a testament to the power of determination and the willingness to take risks. The second story is about a couple who sailed from Los Angeles to the South Sea Islands. They owned a sailboat and a business together, and they took turns running the business while the third partner enjoyed sailing. This arrangement allowed them to spend for months exploring the South Pacific. Their story highlights the importance of trust and partnership in pursuing a life of freedom and adventure. These stories, along with many others the author has encountered over the years, serve as examples of individuals who have broken free from societal expectations and embraced a life of their own design. They have chosen to prioritize experiences and personal fulfillment over material possessions and societal norms. The author believes that this freedom is the most valuable thing money can buy, and he offers strategies in his book to help others achieve this level of independence and fulfillment. In this final chapter, the author shares some thoughts on risk and the mindset needed to pursue financial freedom. They challenge the notion that investing is a form of deprivation and instead emphasize the power of having money, the freedom to make choices and live life on your own terms. While investing does involve risk, the author reminds us that the stock market has historically always gone up, even through major world events. They also debunk the idea of absolute security, highlighting that risks exist no matter what we do. From economic downturns to natural disasters, there will always be uncertainties. However, the author reassures us that the likelihood of catastrophic events happening in our lifetime is extremely low. They encourage us to focus on the risks that matter and make informed decisions based on our needs, psychology, and goals. The author also emphasizes the importance of overcoming fear and not letting it control our financial decisions. By understanding how investing works and staying focused on our long-term goals, we can navigate market fluctuations and build wealth. The chapter concludes with a reminder that the path to financial freedom is within reach, and all we need to do is take the first step and enjoy the journey.